Hello and welcome back to our channel. In our last video, we did a very quick recap of some of the key ideas we've covered over the last few weeks. I reminded you of the elegant idea of 100 minus your age and how this can help you get your mix of aggressive versus defensive investments roughly right based on your age. We focused on the idea that all you might need to do when it comes to your aggressive investments is to choose a large stock market of some kind. Today, we move on to look at how you might think about defensive investments. And a key point to make here is that the defensive bit is a good deal trickier than the aggressive bit. At least it certainly has been in recent years. And this is because real interest rates, so that's interest rates after inflation, have been so low or even negative for a long time. As I explained in the video where we first introduced the idea of 100 minus your age, traditionally, the defensive bit of someone's 100 minus your age portfolio would have been allocated to bonds. In the UK, many financial advisors would have used UK government bonds or gilts, and in the US, they might have used US government bonds. In recent years, this would have been problematic because interest rates and bond returns have been very low for most of the time since the financial crisis in 2007. In fact, in the UK, real interest rates after inflation have even been negative for a fair bit of the last decade or more. Arguably even more important in the last few years, however, as interest rates have risen, this has caused the price of many bonds to fall a long way, because bond prices fall when interest rates rise. This has been hugely damaging to plenty of portfolios and particularly to many British pension funds, which have been increasingly pushed into buying bonds by ill-considered government policy in recent decades. Given all of the above, bonds have often proven to be a poor place to have your defensive investment capital for quite some time now. And this has meant that the defensive bit of your portfolio could quite possibly have been losing you money in real times for some time. Not ideal, and particularly if you're a bit older and you might have a big chunk of your money that you want to invest defensively based on the idea of 100 minus your age. So today I wanted to explain that this is one of the key reasons that we built and launched our own investment fund, the snappily named VT-PEF Global Multi-Asset Fund. We wanted to call it the Own the World Fund, by the way, but we weren't allowed to do that for reasons that are far too boring to go into. Anyway, before I explain a bit more about our fund, there are a few important points to make. First, because I will be explicitly talking about our investment fund, this video must be considered to be a financial promotion according to the strict rules that exist around such things, and it is disclaimed as such. We obviously have a high level of commercial self-interest in highlighting our fund as an option here. And next on that topic, for the more cynical folk in our audience who might find it rather off-putting that I'm talking about our own investment fund today, I wanted to say a couple of other things quickly. First, that I hope you will notice that this is the first video in nearly a year of posting educational videos for you on YouTube where we have done anything in any way salesy or commercial. And secondly, importantly, the broad point I'm making about our fund in this video is that we would like to think it could be a solid potential option for the defensive proportion of someone's 100 minus your age portfolio, or for anyone who is particularly risk averse or who is very focused on protecting against the risk of loss as they approach retirement perhaps. And in making this point, and if you follow the broad idea of 100 minus your age, what this means is that I'm suggesting that a 30-year-old, for example, might have fully 70% of their money not in our fund, and instead in the more aggressive assets we've covered in previous videos. A 40-year-old might have 60% not in our fund. And I hope you might agree that this is a pretty rare approach for a fund management company to take. Our whole approach, big picture, is around using the right mix of assets of aggressive and defensive investments to seek to get a great risk-adjusted return over many years of investment and to protect you against a catastrophic loss. I've shared many hours of video to explain this approach in recent months because I really believe that it works, and it can give you real peace of mind once you understand all this stuff too. So this all having been said, today I wanted to explain how our fund seeks to do what it says on the tin, particularly when it comes to the defensive element of what you might want to do over many years of investment. I would also hope that the ideas in this video should be of general interest, whether or not you want to have a look at our fund, by the way. So first and foremost, our fund seeks to protect against significant loss. And to do this, it uses two key investment techniques. And these are, first, what we call true diversification, and secondly, something called formula-based trend following. So to get to each of those in turn. As a reminder, diversification is just the finance industry's word for spreading your risk around many investments, of not having all your eggs in one basket, if you like. And true diversification is when you do this by asset class and by geography. Our fund looks to own a large number of investments from all over the world and across all of the main asset classes. This compares to many funds which tend to focus only on one asset class, such as just shares or just bonds, for example, or on only one country or region, such as just the UK or just the US. Many of the smartest and wealthiest investors in history have shown how effective owning all asset classes in all major regions of the world can be. This is because those main asset classes, so shares, bonds, cash, property, and commodities, respond differently to various stages of an economic cycle, such as growth, deflation, inflation, stagnation, and so on. This is why we believe that a good approach is to look to own most major assets in most major regions of the world, i.e. true diversification. And as you may know by now, we call this owning the world, and this was the subject of my first book, or at least part of my first book. Anyone who has followed us for any length of time will be familiar with this idea already, and many of the wealthiest and most financially literate people in the world have invested like this for more than a century. This includes the endowment funds of places like Oxford and Cambridge and Harvard and Yale too, by the way. And it should intuitively make sense to you why this might work. From 2007 to 2009, for example, many stock markets all over the world more than halved. But oil hit an all-time high in 2008, and gold went up more than 23% in 2009, priced in dollars. Sometimes Asia is great and Europe stagnates, and sometimes America is the place to be. The easiest thing to do is just do your best to have exposure to all major areas of the world. And you might think that this approach will mean you end up with indifferent performance, but the evidence of history is that this is not the case over long enough periods of time, at least. In the early 1980s, famous US investment writer Harry Browne said about this approach, over broad periods of time, the winning investments add more value to the portfolio than the losing investments take away. Award-winning British investor Tim Price has called this kind of diversification the only free lunch in investment. And Jack Meyer, who used to run the Harvard University Endowment Fund and achieved an average return of 15.9% a year under his tenure, has said, the most powerful tool an investor has working for him or her is diversification. True diversification allows you to build portfolios with higher returns for the same risk, and most investors are far less diversified than they should be. This is why our fund owns a wide range of assets from all over the world, which are a matter of public record, by the way, in our documentation. Our second main investment technique is known as formula-based trend following. To explain, looking at financial data as far back as practically possible, and in our case all the way back to 1872 as it happens, and across essentially all markets, academic research and real experience has shown that the positive or negative direction of any financial market is statistically more likely to continue than to reverse. This may seem a little strange, but is actually just a simple function of human nature. If a share or market has been going up steadily, then all other things being equal, there is a good chance it will continue to do so, if only because of the herd mentality of human beings. American shares have given us a great example of this for quite a few years now, as we've covered in previous videos. Trends are well known and reasonably well understood and have been driving boom and bust cycles for centuries. And as a result, over a long period of time, academics looking at financial markets have worked out a number of methods for predicting where prices in a market will likely go based on where they have come from. This isn't 100% accurate, of course, but this broad approach to investment is known as technical analysis, and it can generate strict rules which help investors buy and sell with a higher probability of success. Arguably one of the most effective of such techniques is called trend following. Trend following simply takes a current price of an asset and compares it to a historical average price. If the current price is above the chosen historical average price, then the investor remains invested in that asset. And if the current price falls below the relevant historical average price, then the investor sells out of the asset and switches those funds into cash or something similarly defensive to protect against further falls. Preserving capital this way is extremely important for all the reasons we've looked at in this video series, and particularly as you approach retirement. The level at which such a strategy will sell out of an asset will be based on a strict, disciplined, consistent, and rules-based process. And equally, when the price of an asset starts to rise again, the strategy will look to buy back in. This methodology and broad approach is proven in practice and tested over more than a century with different assets and in different countries. And it can have a significant effect on protecting against big falls in all markets and of improving returns over sufficiently long periods of time, given the crucial importance of preserving your capital. And this is precisely what our fund seeks to do. So it's worth highlighting that the price such a strategy can pay for this downside protection can be relatively long periods where it may not do very much. It's very important to note that our fund and this sort of strategy is very much an investment tortoise rather than a hare. Our fund tries above all else to avoid ever suffering a massive fall, with the result that you might then sell out of your position in a panic, or at the very least would then need to make huge returns to get back to square one because of the way the maths work. As a reminder, remember that a 100% return is needed to recover a 50% loss. In many ways, our fund strategy is more like a savings plan than many more conventional funds. If you save and invest a certain amount every month without fail, you will build a significant sum over time, even at times when the fund might go nowhere, just as you would by saving money in a conventional savings account. The difference is, of course, that in the event that there is a long and durable upward trend, which happens every few years based on more than a century of evidence, you will then be making returns on all of that capital, meaning that your long-run result could be some way ahead of what you might have achieved in a cash ISA, current account, mattress, or bond fund. So if you want a wide selection of assets in one place and to avoid the stress and administrative hassle of figuring out how to do that, you may find our fund a good option, particularly for the defensive proportion of your portfolio. And you can find out more about how it works and all the details by downloading the fund overview document from our website, which I like to think is also a good educational piece whether or not you want to invest in the fund. It's very important to stress that past performance is not an indication of future performance, but in the several years since we launched the fund, it has significantly outperformed many bonds and bond funds and UK gilts, which many British investors might use as a defensive investment. Anyone using the idea of 100 minus your age and then investing in a big stock market, as we've suggested previously, and our fund in the right proportions would have had a pretty good result over time overall, particularly on a risk-adjusted basis. Big picture, this combination of aggressive and defensive investments based on your age has a good chance of capturing upside and of protecting your downside over long periods of time. And we would also like to think that this approach should give you real peace of mind along the way, given that you're getting the mix of assets roughly right based on your age. The impact of a large stock market crash should therefore be limited and far less impactful as you approach retirement than many of the more risk-on approaches to investment that so many people are taking these days, such as putting everything in crypto or taking the market purist approach of investing only in the stock market. Both of these approaches are far riskier than many people realize at the moment, given such a long and strong run in US shares in particular. Remember that it only takes one big crash year to erase quite a few years of outperformance, and it's really important to understand this and have a plan when you invest. And by the way, before I sign off today, another asset which I believe can be considered as defensive is gold, which you may know that I've been writing about for more than 10 years. Gold has performed very well for a defensive asset for the last many years, particularly for UK-based investors who care about performance in British pounds. And here I'm putting up the chart of the gold price roughly since I first wrote about it in How to Own the World. We will cover gold in more detail in a future video. So that's it for today. I hope you will forgive my having covered our fund as one potential option when talking about defensive investments. But as I say, in an era where defensive investments have been so particularly hard, we do believe that it serves a purpose and does what it says on the tin, if used appropriately. And as ever, if you want to ensure that you're one of the first to see our videos when they're published, please do click the subscribe and bell buttons. And if you'd like to hear more from me, please do feel free to connect with me on any or all of LinkedIn, Facebook, and Twitter or X. And of course, please do subscribe to our free email service from the Plain English Finance website. Until next time, I wish you the very best.